very much. I apologize. I have to do this speech in English. I'm afraid my Italian language is not good enough. I hope you have translation. I will try to speak slowly. So I think what I'm going to do is not to tell you what you should do or what I think would be good for you, because in fact I'm not sure or I don't know. I'm going to tell you basically what are the major topics in terms of investment that we are currently discussing with our institutional clients in Europe, including obviously AXA, our parent company, for whom we manage assets, but all our European clients. I see that there are a number of key topics when it comes to investing next year. So we are talking about real life. What do we do with the money now for next year? And I'd like to give you this vision, not only my vision, but the vision of the market, our client base, and what we see in terms of what they are trying to do. So it always starts when it comes to investing with some convictions. You have to have a view. You have to believe something. You have to have a target, an objective. And so I give you our views for next year. I mean, obviously it's always a bit challenging, but basically at AXA Investment Managers, we are confident that the global economy is recovering. So that's what we call the healing of the global economy. We think this is happening. We see signs of recovery, of new growth. We believe that next year the recovery will be fueled by the US economy. We are strong believers in the capacity of the US economy to still push global growth for the next years, although I appreciated the presentation this morning about the long-term view. But for next year, this is still our view. And obviously the big topic in terms of risk is the end of quantitative easing, and so the Fed's tapering, which we have all been expecting or awaiting for some months now. But it will obviously be a huge pressure and something we have to take into account in terms of risks, especially on the long-dated yields. So what does it mean in terms of asset allocation and in terms of asset class? Clearly, what we hear from all our institutional clients in Europe, they are all willing to underweight government bonds, sovereign bonds. And obviously this is due to the fact that everybody agrees that at some point interest rates will rise. And this is obviously because of the end of quantitative easing. This is because of the Fed's tapering. So clearly there is an overall agreement that we should underweight over the long term government bonds. That's the first clear message. The second one is that obviously we still have liabilities to match as insurance companies, as pension funds. So we cannot simply invest 100% in equity, in private equity, in infrastructure. We have some constraints, and therefore we are looking for some other fixed income revenues. And this means obviously credit. We've been very bullish and very aggressive in investing in credit at AXA IM over the last couple of years. Our view for next year is overall what I would say neutral, but with some differences within the credit space. I mean, clearly we still believe that yields will rise and that default is not a big concern for us for next year, especially within the investment grade arena. But clearly, we have a preference for short duration credit instruments because obviously of the threat or the fear that interest rates will rise. And we also believe that within the credit space, valuation has become much more difficult. So the spreads in the credit area clearly have tightened, and it's much more difficult to find paper with good quality and good yield, and the fight for this paper makes the prices not very attractive, so one has to be very selective. And we have a call, which is clearly a call which is positive on equity. We do believe in the European recovery and also in the Japanese recovery. We do believe that the Abenomics program in Japan is starting to have an effect and will definitely pull markets up next year. And we believe in Europe that the systemic risk of a euro breakup is somehow far away. And that we can live in confidence with investing in Europe. We have seen, obviously, over the last 8 months, significant inflows within European assets, and namely European equities, coming from Asian investors, coming from the Middle East investors, who wanted to diversify away from US equity, as they are valued pretty high. And so European equities are cheap compared to US equities. And we still believe that it will drive some interesting growth, even though we don't expect that we will necessarily have a double-digit growth or increase in equity European market like we have seen this year. We are clearly cautious on emerging markets. That's one of the topics of the day. For next year, we believe we have seen, obviously, the very, very quick reaction of the markets as soon as the Fed earlier this year has made an announcement about tapering. We have seen immediately the impact on emerging market equities and bonds, actually. So we believe that quantitative easing will start to decrease next year, and therefore we are still concerned with the impact on emerging market. Obviously, this uncertainty about when tapering will start will create some uncertainty and some volatility in the market. So we will have to live with that. But clearly, we still believe that the call or the request we get from our clients are basically, how do I underweight sovereign bonds? How do I find some interesting opportunities in the credit space? And give me a way to invest more in equity when I still need to control the volatility of this asset class. That's the request we get clearly from our clients. And obviously, that's the starting point. But as you know, investment management is about having an objectives and trying to find a real way to implement solutions, taking into account our constraints. Unfortunately, we don't live in an ideal world when it comes to investing. We do have constraints. They come from our liabilities that we have to match. Therefore, we need fixed income. They come from the regulation. All types of regulations in Europe have one thing in common. They are all risk-based regulation. It means they prevent us to invest more or as much as we would like in risky assets, which is a kind of a paradox, obviously, because on the other side, we need to look for higher returns because of the low rate environment. We need to take more risks to give policyholders what we have guaranteed. But the regulation is there basically to push us away from risky assets. So there are good reasons for that, but it's a constraint that as asset managers, we have to take into account. And obviously, as I said, quantitative easing, it's all about the timing. We all know it will happen. The big question to which we have no answer is when. Personally, my view is that it should happen end of Q1. So we have a view that it will start end of Q1 next year, but it's very uncertain. And so taking all that into account, these objectives for next year and the constraints of institutional investors, there are three big topics we are working on these days with our customers. The first one is to provide fixed income alternatives to sovereign bonds. The second one is to find solutions to increase exposure to equity with a good control of volatility and risks of this asset class. And the third topic, which is coming back and which is due to this uncertainty of the market, is a more flexible way to manage the portfolio, a more reactive way to manage the portfolio, so we can adapt the risk factors of the portfolio according to violent market movements. So I will just say a few words on each of these topics to illustrate a little bit in real life the types of solutions that we are currently working on. The big topic has been for the last 9 months, and I believe will still be for next year, is the great rotation. But it's not the great rotation that we expected. You remember earlier this year, everybody was talking about this great rotation trade. And it was supposed to be a trade shifting from bonds to equity. This did not happen because we have seen inflows in equity, but they were not as huge, as big as we expected. They were not in the magnitude of a great rotation trade, and they were mainly coming from overseas, from the Middle East and from Asia, not from European institutional investors. What institutional investors have done, and what they are still trying to do more, is basically to rotate within their fixed income portfolio. And that means exiting, redeeming sovereign bonds, because the yields are obviously too low, and find some diversification within the fixed income space to basically increase the yield. And I gave here a few examples. I mean, clearly the vast majority of the projects we are working on are trying to find some short duration fixed income instruments for the clients, so that short durations, you have a lower exposure to interest rates if they increase in the future, but still you get some fixed income revenues. We also worked on some programs to basically provide some hedges against interest rates rising. And we have created in some of our mutual funds some specific share classes that are the same as the one of the mutual fund, but with a hedge on interest rates. So it's a fixed income fund with a specific share class, which is hedged against a rise in long-term interest rates. We call them the REDX share class, and that's something which has been quite popular. And obviously, high yield is still a big topic. We are still seeing inflows, positive inflows in our high yield programs, although I have to say, as I mentioned before, it's much more difficult to find investment grade, good quality type of paper in that area. Another big topic of development for us for next year is what we call the most illiquid fixed income alternatives. So clearly that's something which is going to develop, and in particular in the loans space. You know that some European insurance companies have taken initiatives in that field. AXA has done it yet. So I think we have now more than 7 billion euros invested in commercial real estate loans. So that's a nice diversification within the fixed income bucket. We have also developed in SME loans, so corporate loans. And obviously we believe this is great, and this is something we are discussing on an ongoing basis with regulators and governments, because this is a great way for us as long-term investors to finance the real economy and basically invest in the real economy through the funding of loans to SMEs. It's a sensitive topic, obviously, because from a regulatory standpoint, you need to get it right. You need to make sure that you are not taking risks that you don't control as an asset manager. Loans is for banks. Banks know how to analyze credit risks and grant loans. So the way we do it at AXA is basically that we always co-invest with the bank. The bank is showing us some loans, and if we decide to participate in the loans, we always do it with the bank. That's a way to make sure that interests are aligned with our interests. And another topic are the insurance-linked bonds. It's definitely a vehicle that has been very interesting. In many markets, there were also opportunities, and there are still opportunities, to make a nice swap between the sovereign bonds and the inflation-linked bonds, because typically in many markets, inflation-related bonds, they trade at a discount compared to the sovereign bonds itself. And so you can very easily do an asset-backed swap where you keep your sovereign bonds on your balance sheet, but basically you buy the inflation-related bonds, which is trading at a cheaper price with the same risk. So that's the first topic, which is probably the most important one. The great rotation is happening. It's going to happen again next year, but it's not the one we expected. It's not from bonds or from fixed income to equity. It's definitely within fixed income, from sovereign bonds to credit and more alternative type of credit. The second type of solutions we are working on these days is definitely trying to find some ways to allow insurance companies and pension funds to reinvest more in equity. And obviously here comes the problem of regulation, because equity means huge capital requirements. So it costs a lot in terms of capital. And obviously also it's volatile. So it means it creates volatility on our clients' profit and loss accounts, and they cannot afford that. The regulator don't allow them to afford that. So we try to find some solutions, some ways to give them an opportunity to invest in equity, but with a better controlled volatility. And here I just put an example of what we call a volatility capped strategy, where you see on the top chart that this strategy basically is giving you the returns of the equity market, but you see on the down chart that the volatility, it is the blue line of the product, is much lower. And how do we do that? It's very simple. It's just, there is no derivatives, no options in the product. It's just a discipline, a way to manage the allocation to equity with a constraint, which is to say we don't want this portfolio to have a volatility higher than 20%. It means as soon as the portfolio's volatility reaches 20%, we sell, we stop investing, and we invest in non-risky assets, so that we make sure that the volatility of the portfolio is permanently below 20%. And in doing that, we still get, as you can see, a very nice correlation with the equity performance. So it's one of the solutions that we've been developing for some of our clients to invest back in equity with a lower volatility. And the last topic I wanted to mention is flexible asset management. Definitely, I think it's clear from all the discussions this morning, the world is uncertain. And even when we have some certainties, like the fact that quantitative easing will stop at some point, we don't know when it will happen. And therefore, clearly, we have learned from the last years that as an asset manager, we need to be much more reactive. You cannot have a buy and hold strategy and just wait and see what happens. It's not only because market moves. You also have to look at deep insights. Correlations moves. So correlations over the last years have been very, very high. So it's been very difficult to diversify, because any kind of asset class you were investing in, they were all very correlated. They were low correlation before the crisis, but since the crisis, they are very high. However, if you look at in details, you can see that correlation are still very high in terms of geographical sector. So investing in emerging market versus the United States versus Europe does not give you great diversification. There is one correlation that has already significantly decreased, is the correlation within the credit asset class. And it means what? It means if you want diversification, you need to look at in details, and you need to look at how correlation evolves between asset classes. Because sometimes you believe you buy, say, a credit portfolio, and you believe it's diversification compared to your equity portfolio. But maybe, in fact, this credit portfolio is 95% correlated to equity markets. And so you have an equity portfolio, but in fact, you have a credit portfolio, sorry, but in fact, it is still an equity risk. And these correlations, they change in time. They vary. So you've got to check, on a regular basis to make sure your diversification still works. And here I have just shown an example of one of our multi-asset fund, and you can see how we change the asset allocation in a very dynamic way. This year, this fund is delivering 6.5% of return with a low volatility, so below 8%, I think, this year. So, this is delivering good result because it's not rocket science, it's not magic. It's just because we live in markets where it does deliver value to do that. It does deliver value in such a market which is volatile, which is uncertain, to manage actively your portfolio. Clearly, before the crisis, you were better off invested in tracker funds, in ETF, buy and hold, everything, low correlation. You could have a nice diversified portfolio, buy and hold, just wait, and you knew exactly what was going to happen. This is no longer the case. This is why we see more and more mandates and requests from institutional clients to implement some dynamic asset allocation program. That's it for me. So thank you very much.
Thank you, Nat.